Welcome to the Stock Market Palantir. Today we are going to talk about RVYL. RVYL Inc., trading as RVYL, has really been captivating the market lately. We're seeing some truly massive, sustained volatility. And it's all following that September 2025 announcement of its definitive agreement for a reverse merger with the private Web3 media tech company RTB Digital, also known as Roundtable. So our debate today really centers on one core question. Is all this extreme price action, this speculative frenzy, is it actually justified by the genuinely transformative assets and, the powerhouse leadership coming in? Or is this just a momentum play, a speculative bubble completely divorced from financial reality and frankly burdened by catastrophic structural risk? I maintain that the incoming assets, the clear strategic pivot, and the pedigree of the management, they provide a strong justification for the aggression we're seeing in the stock.
And I appreciate the case you're building for that narrative, I do. But I'm approaching this from a fundamentally different perspective. We have to separate the excitement of the pitch deck from the cold, hard realities of the transaction structure and the legacy company's financial distress. I'm going to argue that this volatility is pure speculative momentum. It's a narrative premium built on sand, and it's burdened by a level of structural risk and dilution that makes the current valuation highly, highly precarious and fundamentally unsound.
Well, let's look at why this is a rational, albeit high-risk speculation. This isn't a merger of equals. It's a strategic, let's call it a take-under. What was an insolvent, failing fintech shell is instantly being transformed into a revenue-generating, high-growth Web3 digital media platform. The value here is entirely tied to RTB Digital. The filings confirm RTB operates a fully funded enterprise SaaS platform business that's software as a service, a recurring revenue model with a proven seven-figure annual run rate and actual millions in Web3-based revenue. So this is not just an idea, it's an operating business.
It is an operating business, yes, but we cannot just ignore the host entity. That failing fintech show was frankly a company in terminal decline. Their balance sheet was insolvent. We're looking at a negative equity position approaching $7 million as of June 2025. Revenues had collapsed by 46% year over year. This wasn't a strategic alliance. This was RVYL selling its highly valuable NASDAQ listing to a private company just to avoid certain failure and delisting. You're asking investors to bet on a future entity while ignoring the severe financial hole it's starting in.
But the market has already factored in the failure of the old entity. It's pricing in the new leadership and the new vision. And this is where the A-team comes in. Look at James Heckman, the incoming CEO. He was central to architecting the MySpace-Google advertising alliance, and he founded Rivals.com. He has a profound ability to build media value. And maybe even more compelling is Eyal Herzog, the founder of Bancor. The man holds patents for key DeFi protocols, specifically automated market makers and liquidity pools. Their involvement, coupled with the aggressive Bitcoin treasury strategy, the pledge to contribute over $30 million in BTC, is validation enough for aggressive speculation. The market is buying expertise.
That's a compelling point. Based on pedigree, I'll give you that. But I'm just not convinced when you dismiss the mechanical reality of the transaction. You mentioned a take-under, so let's quantify that cost. How can the current price action possibly be rational when legacy holders are immediately diluted by nearly 85%? Legacy RVYL shareholders will retain only 15.15% of the combined entity, while RTB shareholders receive the other 84.85%. This isn't just dilution, it's a structural liquidation where the assets are overwhelmingly transferred to the private entity. The stock price surge is completely detached from that core punitive reality.
I see why you'd think that, but I would frame it differently. This 15% ownership is the high-stakes trade-off. We are trading 100% of a guarantee of zero, 100% of a bankrupt, defunct company, for 15.15% of a realistic shot at generational wealth, driven by a proven team. If Heckman and Herzog successfully execute the RTB Digital strategy, which is already generating recurring revenue and partnered with giants like Yahoo and the Paris Saint-Germain football club, then 15% of that successful entity will be worth far, far more than 100% of the old RVYL shell. The market is correctly looking forward, and it's pricing in the anticipated success of RTB.
I appreciate the vision you're painting, but let's talk brass tacks. If the market is so convinced of this future value, why is the trading volume so chaotic? Over 450 million shares have traded since the announcement. We saw days where volume hit 68 million shares on a float of only 31 million. That doesn't prove strong long-term conviction. It proves pure chaos and short-term algorithmic arbitrage.
I disagree, fundamentally, that this volume is chaos. The high trading volume, coupled with observable high retail interest, especially on platforms where, nano-cap speculation thrives, demonstrates that there is strong bullish conviction in this transformative narrative. The volume is an expression of liquidity, which is necessary for a radical transition like this one. Retail traders are betting on the Web3 pivot and the Bitcoin treasury.
I'm sorry, but I just don't buy that. And let me tell you why. The volume is chaotic and not strategic. We need to look at the trading data itself. The market activity is overwhelmingly driven by algorithmic arbitrage. The source data shows a consistently high off-exchange short volume ratio. We're talking in the high 50s to low 60% range in early November.
Could you just clarify for our listeners why that off-exchange short volume figure is so relevant here?
Absolutely. A consistently high off-exchange short volume ratio suggests sophisticated, institutional selling pressure happening outside the primary exchanges. Now, when you combine that with the known presence of high-frequency trading or HFT firms like Citadel Advisors and Jane Street Group, who only hold tiny token institutional positions of 1.78%, it confirms that fast money is just scalping the volatility. They are exploiting the retail frenzy, not confirming long-term commitment. The volume isn't conviction. It's HFT algorithms profiting from the massive price swings created by the narrative.
We can certainly agree HFT firms are capitalizing, but they're parasitic. They're just riding the momentum that's been generated by legitimate conviction in the transformation. However, let's pivot to maybe the most concrete, unavoidable structural risk facing this whole project.
You mean the reverse split contingency?
Precisely. The merger is explicitly contingent on shareholder approval for a new reverse split up to 1-for-15, scheduled for a vote on December 15, 2025. This is required specifically to regain NASDAQ compliance. Consolidation of shares is usually a bearish action, and it poses a very material execution risk. If the legacy shareholders, who, let's remember, are already being diluted into insignificance, if they reject this split, the merger dies, and the stock is potentially worthless. That contingency risk alone should be weighing down the current speculative price, yet it appears investors are ignoring it completely.
Which just confirms the speculative nature of the trading. It is hard to argue for fundamental health when the company has to force a corporate action simply to satisfy minimal listing requirements.
But let's analyze the incentive structure of that vote. The reverse split is a mechanical requirement, not a strategic option. If they want the listing and the Web3 upside, the split has to pass. Crucially, the speculators who have piled into the stock after the merger announcement, drawn by the RTB vision, have a direct and overwhelming incentive to approve the split. Voting no kills the very upside they paid a premium for. So given the consequences of killing the deal, the probability of rejection, while real, is low. The focus should stay on the value being acquired.
That is an optimistic assumption about shareholder alignment. We're talking about forcing consolidation on a shareholder base that's already feeling penalized. The fact that the entire future hinges on this one mandatory vote dictated by the insolvency of the legacy company confirms that this situation is driven more by financial engineering and hope than by any established stability.
So ultimately, the current market frenzy around RVYL is a spectacular high-risk, high-reward bet. Investors are placing their chips on the new Web3 vision, on the undeniable track record of Heckman and Herzog, and on the competitive advantage offered by the substantial Bitcoin treasury. The future value is entirely tied to the successful execution of the RTB digital strategy, which, as we've said, has significant existing validation through major media and sports partners.
And my position remains that this is currently a lottery ticket, not an investment. The evidence is overwhelming. Catastrophic dilution for legacy holders, the inherent financial failure of the legacy company, and the prevalence of highly sophisticated algorithmic trading. It all suggests the stock price is detached from any verifiable fundamental reality. until the new entity actually executes and the critical merger contingencies are finalized. We are watching a textbook battle where a compelling narrative and financial engineering are battling against fundamental distress and structural hurdles.
The case of RVYL is indeed a complex microcosm of modern markets. It's illustrating how a powerful transformative narrative can instantaneously override immediate financial limitations. It is certainly a situation that's going to demand rigorous scrutiny over the next few months as we approach that December deadline. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.